A warning from CoreLogic just rocked Tampa. A 70% chance that home prices here keep falling, putting this city at the top of the nation's crash risk. In barely a year, Tampa's once booming housing market has flipped. Prices down across every major index, momentum reversed, investors cutting losses. How did Florida's pandemic destination become a cautionary tale almost overnight? And just how much further could Tampa fall? A 70% probability. That's the figure CoreLogic assigns to Tampa's risk of ongoing home price declines. A number that stands out not only for its size, but for the authority behind it. CoreLogic, one of the most trusted names in global real estate analytics, rarely issues warnings this stark. Tampa doesn't just top Florida's risk charts. It now ranks among the 5 most vulnerable markets in the United States. Chief economist Dr. Selma Hepp leads the CoreLogic team behind these probability models, built from decades of transaction records, mortgage applications, and listing data. Her analysis points to flattening prices, surging inventory, and shrinking demand, indicators not of a mild slowdown, but of a market reversal. CoreLogic's risk model tracks how quickly homes sell, how long they sit unsold, and how many undergo price cuts. In Tampa, nearly 1 in 3 listings has seen a reduction, while new inventory continues to climb. The company's methodology, proven accurate before the 2008 downturns in Las Vegas and Phoenix, is detecting early-stage correction patterns again. And the language CoreLogic now uses is blunt. Florida markets are falling out of favor. For Tampa, this isn't a cooling period, it's a retreat. The city that once drew nationwide investment is now Florida's epicenter of decline, trailed by Winter Haven and West Palm Beach. Across every data source, the story aligns. The Zillow Home Value Index shows Tampa values down 5.6% year over year, the sharpest annual drop since 2011. The S&P CoreLogic Case-Shiller Index confirms a 1.5% decline, while local MLS data shows month-to-month losses accelerating since early 2025. Even Hillsborough County, once among Florida's most resilient markets, reports a steady 0.9% annual drop. In St. Petersburg, declines are steeper, 7.6% over the same period. Momentum has flipped. Between October 2024 and January 2025, Tampa's home values fell another 1.6%, showing that each new report confirms deeper weakness. Across the board, sales velocity is slowing, price cuts multiplying, and confidence evaporating. The city's fall in Zillow's market heat rankings captures this shift vividly, plunging 19 places, from 10th to 29th nationwide, one of the steepest drops of any major metro. Bidding wars that once defined Tampa's frenzy have vanished. Open houses that drew lines of buyers now stand quiet. Only Miami managed to rise in Florida's rankings. Tampa, Jacksonville, and Orlando all tumbled together, signaling a statewide retreat in demand. Behind the numbers lies an oversupply crisis. By mid-2025, over 19,000 homes sat listed across the Tampa metro, the highest in nearly a decade. Builders who launched projects during the pandemic boom now face a market with too few buyers and too many unsold units. Downtown alone has 2,000 new condos and 3,000 apartments hitting completion just as demand collapses. Developers quietly offer huge incentives, $50,000 discounts, free upgrades, or months of no HOA fees just to move inventory. Yet even with those offers, units linger. One developer who began a downtown tower in 2021 said, "We sold out 40% at peak prices by early 2023. The rest have sat for months. We can't drop prices further without breaking loan covenants." At the same time, investors who once fueled the boom are now rushing for the exits. Analyst Nick Gurley of Reventure Consulting tracks hundreds of investor-owned Tampa homes listed at losses of up to 20%. A condo bought for $500,000 in 2022 now sits unsold at $400,000. Institutional owners, including major real estate funds, are liquidating entire portfolios. They call it strategic repositioning, but the records show fire sale pricing, 15 to 25% markdowns to move properties. Gurley puts it simply, when investors are selling at a loss, they're not betting on a rebound. Those discount listings drag comparable values lower, forcing traditional homeowners to follow with their own cuts. In some neighborhoods, especially new developments, price reductions of $80,000 to $120,000 have become normal. The correction feeds on itself. Falling prices trigger more sell-offs, and the confidence that once defined Tampa's boom is gone. Adding to the strain are insurance premiums that have tripled in just 3 years. Average homeowners now pay $6,000 to $8,000 annually, and some coastal properties exceed $10,000. Major insurers have withdrawn from Florida, leaving many Tampa homeowners scrambling for coverage through state-run Citizens. Thousands have received policy cancellations or unaffordable renewal quotes, sometimes exceeding mortgage payments. These insurance costs are tanking deals across the metro. Realtors report contracts collapsing at closing when buyers see final quotes. Properties flagged as uninsurable sit idle for months, even after price cuts. One waterfront homeowner watched her annual premium rise from $3,400 to $8,200 before being dropped by her insurer entirely. She sold at a loss rather than pay $10,000 for limited coverage. Mortgage costs compound the damage. Interest rates remain around 6 to 7%, doubling payments compared to the pandemic years. Even with falling prices, homes are still roughly 40% more expensive than in 2019, while local wages have barely moved. Add insurance and taxes, and the total cost of ownership has outpaced what most families can afford. Buyers who once feared missing out now fear buying too soon. Realtor Jeff Fahey notes that median home prices hover near $412,000, but buyers are pausing. They'll walk away if the math doesn't work. Days on market have climbed from weekends to months, while remote work migrants, once Tampa's biggest engine of demand, are leaving. Data from USPS and census tracking shows outbound relocations up 29% this year, many citing job changes and rising costs. Nationally, Tampa's reversal stands out. The S&P CoreLogic Case-Shiller Index shows New York gaining 7.7%, while Tampa slides. Most U.S. cities are still growing or stabilizing, but Tampa's 5 to 6% drop makes it a national outlier. Analysts agree, this isn't 2008 all over again. Lending standards remain solid and most homeowners have equity. But Tampa's crisis stems from simple economics: too much new construction, too few buyers, soaring costs, and reversed migration. CoreLogic's 70% probability warning is built on inventory surges, weak mortgage applications, and slowing job growth. Together, they paint a market still searching for its bottom. Whether stabilization comes in 2026 or later depends on two variables: lower mortgage rates and a halt to rising supply. If either fails to materialize, Tampa could see further declines before leveling off. The city's story has become a cautionary reminder that even in a booming national market, local shocks, from insurance and climate risk to overbuilding, can undo years of growth. CoreLogic, Zillow, and Reventure Consulting all point to the same conclusion: Tampa's correction is real, data-driven, and not yet done. And as Tampa searches for stability, one thing's certain: this is a market every homeowner, investor, and policymaker should be watching closely. The cycle unfolding in real time, a reminder of just how fragile the housing boom can be, especially in Florida. And if you've followed this far, stay subscribed to Roofline Report so you don't miss where the next market cracks begin to show.